use high risk. If you have a higher leverage, then you can use a lot of risk. So there's a little difference right there. So now risk is basically divided into two parts, right? Number one part is your static risk. Number two part is your dynamic risk, right? The static risk, now most people what they do is they like to use static risk. When you're a new trader, I would recommend you to use static risk. What static risk means is that when you're approaching a trade, you're only approaching the trade from the fact that, okay, I'm only going to be using one position, and one position is just going to be one risk. Let's say if someone wants to use, let's say 1% per trade, or someone wants to use 2% per trade. So what they're going to say is that, okay, I'm going to enter a position, but I'm only going to use 1%, or I'm only going to use 2% on one position, and that's my plan, and that's all what I'm going to do, right? Now, someone who's a little bit advanced or who has some more experience, what they might say is that, okay, hey, you know what I'm going to do? I'm going to use dynamic risk. Now, dynamic risk comes in when you're really breaking down your risk. So what this means is like, let's say if you're going to say, I'm going to use 2% risk, but I'm going to break down that 2% into two 1% positions. Really important. Let's say if someone says, let's say we have Mac here, right? Mac, or we have Brian here. And Brian says, hey, you know what I'm going to do, guys? I'm going to use 3% risk on this one trade. But what I'm going to do is I'm going to break down 3% into three 1% positions. Makes sense? Now you're breaking down your risk. That's what dynamic risk is. You're breaking down the risk based on the fact that, okay, I'm going to open one position. If it goes into profits, or if it goes if it retraces to get a better price, then I'm going to enter another one. And then I'm going to enter another one, bringing the total risk to 3%. But when you're using static risk, you're only using one position, and you're only using a static risk, like let's say just 2%, or just 3%, and so on. Formula should be applicable if you change currency to pound at risk. Yes. So basically, when we talk about pips and we talk about normal risk, we're just making sure that it's calculated based on the lot sizes. So just to make it very simple for everybody. Perfect. So let's move on to break time is, let's see if